I'd want to be able to distill four recurring themes out of all the business outlooks of 2021 that you listen to. This is a study done by Manulife International. They say that there are four recurring themes. Number one, a year of two halves. It is very clear that 2021 is a recovery year. People won't discount that. While there are naysayers who would say we have things to look at, we have worrisome developments about virulence of the virus, the way the you know vaccines are gonna get rolled out. While we all agree with that, it's a it's at a time of looking at that full year into basic chunks. That obviously the first half of it will be as problematic as the way we see it now. But as the vaccines get rolled in, as the inoculations happen, like let's say starting July, people are saying, it can start in the third quarter, but we'll all end it by 2022. Sometimes people even say first half of 2023. Hey, all I'm saying is there would be inoculations now, and there were none last year. So if 2021 is going to be unfolding as an investment year, it has to be better than 2020. But I have to look at two halves of the year to see that, yes, the first half will obviously be challenged, but the second half will really be where you see us turning the page. Number two, the K-shape recovery continues. Not a V-shape, not an L-shape, a K-shape. And why do I say that? Because markets are always constrained to be carried by manufacturing, by production. And you would know, the stock market is reflective of that. But the real economy includes huge part services, agriculture. And that's the reason why you might not have that captured, in the markets. You don't have cap. If you're an investor, you have to look at inflation as a given. The real issue becomes, what do you do now? If inflation is really going to be kicking up, how do you now manage and refine your portfolio to position it against inflation? And lastly, the search for yield continues. Obviously, all governments, all central banks of the world will be pushing the stimulus. In the US alone, Yellen has asked for a new set while the stimulus level was already high. And in the Philippines, we're doing that. We're borrowing money for all of these ayudas. We're doing it, and we're passing bills and then coming up with laws to help businesses recover. And that's the reason why people will be looking at interest rates continuing to go down. The belly of the curve, as I will be telling you much later, might increase a little bit, but that's down the line. That's going to be within 5 to 7 years. The short-term scenario, we're still going to be pushing a low interest rate. And if you're not going to deploy your money, looking at the inflation rate, guess what? Look at this. It will be a function of stimulus support, sovereign debt. People are going to be borrowing and borrowing more, and that's the reason why there would be a compounded difficulty in debt service. Why? Governments are going to be getting less and less taxes. Less and less taxes for government, right? But essentially, they have borrowed more. So they will be paying for those debts. And that's the reason why debt service will have to be an issue. It actually lowers interest rates a little further. There would be a virus control imperative. The people who will do well, the countries that will do well, will be a function of how well they do their vaccine strategy and the way they're going to be moving forward. And obviously, everyone will have to restructure for productivity, the use of technology, and the use of resources. This is the snapshot of the world economic outlook regarding growth projections. You're going to see almost all regions of the world are projected to bounce back. But let us focus on emerging and developing Asia, because that's where we are. Emerging and if yields go down to 4 or 5% even, they're still triple, quadruple what you're getting from the bank. triple or quadruple what you're getting from the bank. And on top of it, you're sitting on a fixed real asset that will not be degraded in terms of value by inflation because of replacement cost and because of supply and quantity. See, how do you get to protect yourself if you're holding an asset that's too liquid? And you're probably going to be getting what? 0.5 to 1%. There is no cash flow enough to tide you. And on top of that, you're also exposed to capital losses. The primary residents on their kitty, and they're not going to be lending too much anyway. What did they do? They came up with an over 7% cash dividend last week. Can you imagine that? If a bank is really in dire straits, will you come up with a 7+% in terms of a dividend yield? You won't. You're just simply making shareholders happy. Now here, you're making shareholders happy, and it was a sound move because you have the cash with you. So if the banking system is going to be strong and your NPL ratio, look at the NPL ratio, looks like it's going really high, but that's 3.8%. Do you know the NPL ratio of 1997? It's over 10%. So we're still less than half, about a third of 1997 NPL ratio levels. The FIST was also signed into law. If you have tried this, the Skyway Stage 3, I don't know if you have tried. I have several times. Balintawak to Buendia. Balintawak to Buendia in about 16 to 18 minutes. That's a game changer. North to south commuter station. We now have trains that will go 147 kilometers. This north-south commuter station will connect Clark International Airport up to Calamba, Laguna. And by the end of 2021, would connect Bulacan up till the airport already. So you can see if this comes to fruition, after this pandemic is over, you're going to see a very different Mega Manila. And I'm not done yet. You will see the airports. Everybody talks about Ramon Ang's new international airport in Bulacan. What people don't know is that while that's getting built, Clark is already delivering this year. This year, not next year, not in the next 5 years. There is a new terminal in Clark with, a design that's a mix of the blending of the Arayat Mountains, Pinatubo, and Sierra Madre. If you're going to be looking at this, it's going to be coming up with a passenger capacity of now 4 million. That's how they're doing now. And they're expanding it to a capacity of 12 million. You can just imagine if you have the new airport, if you have the Clark Airport and other airports, we're going to be just like Tokyo. We're so dependent on one or a couple of runways in the Philippines. You can just imagine with international airports now in the south and the north, things are going to be different. Subway that connects the airport all the way to Quezon City. And the MRT Line 7, as I've said, Santa Maria, Bulacan, up till Quezon City. See, if we're going to be looking at this, we don't have to miss out on the bridges. You know why EDSA is so cramped? EDSA is so much of a bottleneck because, quite frankly, it's the only connection between two parts of the metropolis. So everyone gets to it like it becomes an hourglass. It becomes a funnel leading to an hourglass. But if you now have bridges like the BGC Ortigas Center link, BGC to Ortigas in around 10 minutes now. As this bridge is about 1 kilometer long. I don't have the picture yet, but there is another bridge being done in less than 3 hours from Alabang. So all of these are going to be game changers. And all of these developments are going to be there in the next 5 years. What will the prices of real estate be when all of these are already in place? Will you be waiting for things to get better? I like Marvin's question. Invest and wait, or wait, then invest? You would know. For me, the biggest thing of that trick question is one word. It's called price. There will be a price to pay for investing and waiting and investing. And it depends on the choices that we can all make. And I guess when I say pushing value, pushing growth, pushing returns, we have all the options. You will see this is a very volatile stock market. But that's the first half. Remember the tale of two halves? That's going to be a given. The second half will not be a chart like this. It will not be a chart like this. So it depends on when you're going to be involved. This half or wait till the next half. On the fixed income side, look at that kind of a yield curve. You're going to be waiting long term for 20 to 25 years for a 4% growth rate. 15, 20 to 25 years for a 4% gross interest rate. Would you want that? Or would you want to invest in something that would have probably given you that kind of a yield in less than a year or two, or even a few months when things really recover? Even in fixed income, I tell a lot of people, you cannot help it. You have to have money for emergencies. But even the money for emergencies, you will have to roll out and refine so much so that what you don't really need in front of the table can be invested in a little mid-range, 3 years to 7 years, so that at least you get a little bit higher on your rate. You can just terminate that if a real emergency happens anyway. But a huge, very small but sound amount on the shortest horizon because you're going to get hit with inflation. Why is real estate a natural choice? I guess for a lot of us, it's elementary. You have rental, cash flows, and you have the appreciation. It's a double barrel approach to increasing returns and value. But you see, for me, again, this kind of ages me. I am still your digital immigrant. I still go for tangibility. It is tangibility. A lot of our assets today are not just simply financial assets. Many of the assets that the young people are buying can even be imaginary assets. They cannot be held, or the value can be questionable. It can be worth nothing. But you see, I have invested probably for the longest time and for many decades, and I am so sure many of you will agree with me, the tangibility of real estate is a great, great definition of value. It's always going to be there. You're going to see it. You're going to enjoy it. You're going to have it. And people might not be able to take that away from you. It is not something that a lot of people can just walk up to you and say, oh, that has no value at all. And the thing that goes for it would be the replacement cost. Think about it. Even if you buy a condo unit today, in 3 years, can Alveo come up with the same building? Buying the same amount of steel, cement, and glass to put it up? The stone that's necessary to put it up? Replacement cost will be an issue. And lastly, leverage. In terms of the financial factors, leverage. Because the developers are allowing you to get a small amount of commitment in so that you can pay it over time. That's giving you power. Because unlike a stock where you have to pay 100%, in real estate, you can actually pay what? 10 or sometimes even less. I can even show you numbers later on that can be so surprising, short of even saying they're shocking. But there are offers that are on the table. And if there are offers on the table like that, let me assure you, When the year gets cut in the two halves, these deals might not be there for the second half. As markets improve and markets follow through, deals get taken off the table.